over the years, we've regularly had a lot of clients come in and talking about investment properties, and quite often some of these people have been recommended by their accountant to go out and buy an investment property for negative gearing purposes. So in essence, the accountant's chasing tax deductions, and I think it's important to have a look at the risks that you're taking on to chase a tax deduction. Now, in one circumstance, we've had a client that's been recommended to buy a property. They've been looking at a property that would cost close to $400,000 once you include stamp duty and all the other costs to buy property. And keep in mind, it's extremely expensive to buy property. Now, that's 400 grand worth of debt. For me, that is a lot of risk to take on to chase a tax deduction. So 400 grand, 6% interest cost per year, that's $24,000 in interest. Then there's rates, then there's insurance, there's water cost and maintenance. So you can see how the cost to own this property can quickly add up to probably $27,000, $28,000 per year. Now obviously the negative gearing side of it, that you may only get after fees and commissions, you may only get $20,000 per year from this property. So that gives you a loss of $6,000 per year, and that's what the accountant is sometimes chasing, where you get this $6,000 loss gives you a tax deduction. And say if you've got a tax rate of 34%, it will save you 34 cents on the dollar. So it's essentially spending money to save spending a dollar to save 34 cents, which is something we don't advocate. What we do think about is making sure that we put the merits of the investment first and we put tax second every time. So is it a good idea to go into debt in the first place? Is 400 grand a lot of risk? Absolutely it is. Now the reason why the banks won't tap you on the shoulder and say, hey mate, are you sure that you want to go into this much debt? The reason why they won't do that is they've got to meet their sales targets. So the more money that you borrow, the better. So I think we should be very wary around going into debt, as I've always said. Very wary about going into debt, and a lot of debt into one asset. What if that one investment property goes bad? What if you have bad tenants? What if you have no tenants? So there's a myriad of things that can go wrong here. There's a lack of diversification. As an option for a lot of clients that come in with this type of strategy, it's a lot of money into one asset. I said, well look, if you want to borrow to invest, that's fine. Let's borrow 50 grand and let's invest into a wide array of different investments. And that can include property that's listed on the stock exchange. And if you want to get out of it, it's easy to sell down any asset on the stock exchange and have the money in 3 days. So there's other ways to skin the cat. Be wary of risk, and be careful of buying overpriced properties or going into property just for tax benefits.